Welcome to the introduction to the share market, often known as the stock market. This complex web is where shares of publicly held companies are issued, bought, and sold. It can serve as a vital indicator of a country's economic health and a crucial area of personal investment. For many, the market offers an opportunity to grow personal wealth over time through careful selection and management of stocks. However, for newcomers, the share market can appear daunting due to its volatile nature and the array of choices available. Understanding the share market begins with recognizing its primary function: to facilitate the exchange of securities between buyers and sellers, thereby providing a marketplace. Companies list their stock on the market to raise capital from investors, and in return, investors get a chance to own a part of these companies. The price of each stock is determined by supply and demand dynamics in the market, which in turn are influenced by various factors including economic indicators, company performance, and global events. Navigating the share market requires a grasp of its fundamental principles, such as equity, dividends, and capital gains. Equity represents ownership in a company through the holding of stocks. Dividends are a portion of the company's earnings distributed to shareholders, and capital gains are the increased value of a stock over time. Each component plays a critical role in the overall strategy of stock market investing. For beginners, the key to mastering the share market lies in education and cautious participation. It's not about making quick profits, but understanding the long-term growth potential of well-chosen investments. With this foundational knowledge, we can explore how to start investing in the next section. The journey into stock market investing begins with choosing the right platform. Today, there are numerous online brokerages that offer user-friendly interfaces, educational resources, and lower transaction costs, making it easier for beginners to start investing. These platforms often provide a suite of tools such as stock screeners, analytical reports, and real-time data, which can help in making informed decisions. When selecting a platform, it's crucial for beginners to consider factors such as fees, the availability of customer support, and the types of investments offered. Some platforms cater specifically to novices, offering guided tours of the market, simulated trading experiences, and comprehensive educational materials. These features can be invaluable for building confidence and competence before committing real money. In addition to online brokerages, new investors should familiarize themselves with basic financial tools and concepts. This includes understanding how to read stock charts, the significance of market indices like the S&P 500, and the basics of portfolio diversification. Diversification, or the process of spreading investments across various financial instruments, is a key strategy to manage risk and reduce the impact of any single investment's performance. Furthermore, beginners should start by investing small amounts and gradually increase their investment as they gain more experience and confidence. It's also advisable to start with less volatile stocks, such as those of large, established companies, and to consider using automated investment strategies like robo-advisors. These automated platforms can help manage investments based on the investor's risk tolerance and financial goals. Determining the right time to invest in the stock market is a common quandary for beginners. While the timing can significantly affect returns, it is often said that time in the market is more important than timing the market. Long-term investments tend to smooth out the volatility and yield positive returns, as historical market trends have shown. However, there are strategic times that can potentially enhance investment outcomes. For instance, investing during a market downturn, when stock prices are lower, can result in more favorable long-term returns. This strategy requires patience and a contrarian view, as it involves buying when others are selling. It's crucial, however, not to attempt to time the bottom, as this is incredibly difficult, even for professional investors. Economic indicators can also provide guidance on when to invest. For example, a strong economic outlook or positive growth in corporate earnings can be good indicators of a healthy market environment. Conversely, high interest rates or inflation might signal a riskier time to invest. Keeping an eye on these indicators can help beginners make more informed decisions about the timing of their investments. Additionally, beginners should consider their personal financial situation and goals. If you are investing with a long-term perspective, such as saving for retirement, the best time to start investing is as soon as possible. Regular investments over time, known as dollar cost averaging, can help mitigate risks associated with market timing. This approach involves investing a fixed amount of money into a particular investment at regular intervals, regardless of the share price. Section 4. Understanding the risks, what every investor should know. Investing in the share market carries inherent risks. The value of investments can go down as well as up. It's vital for beginners to understand these risks before diving into the market. Market risk, or the potential for investors to experience losses due to factors that affect the overall performance of the financial markets, is a primary concern. This type of risk is unpredictable and not easily mitigated, but being aware of it is crucial. Another significant risk is volatility. Volatility refers to the frequency and magnitude of the market's price movements. High volatility means the value of investments can fluctuate sharply over short periods, which can be unnerving for new investors. It's important to assess one's own risk tolerance and adjust investment choices accordingly. For instance, stocks of established large companies tend to be less volatile than those of smaller emerging companies or certain high-growth sectors. Section 5. Conclusion: Smart investing for long-term success. Smart investing in the share market doesn't just involve picking the right stocks. It's also about managing risks, understanding market conditions, and maintaining a disciplined approach. For beginners, starting small and choosing investments wisely is key to gaining experience and building confidence. It's also essential to stay informed about market trends and economic factors that could affect investments. One of the most effective strategies for managing investment risk is diversification. By spreading investments across various sectors and instrument types, one can reduce the impact of a poor performance in any one area. Additionally, employing tools like stop-loss orders can help protect against significant losses, providing a safety net during volatile market periods. Moreover, continual learning and staying updated with financial news and advancements will equip investors with the knowledge to make informed decisions. Participating in forums, subscribing to investment newsletters, and following reputable financial analysts can be beneficial. Ultimately, the goal of investing in the share market should be to build wealth steadily over time. By adhering to these principles and approaches, beginners can navigate the complexities of the market and achieve long-term financial success.